Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Okay, Sonali, I don't know about you, but I do everything I can to avoid going to the pharmacy. The products are expensive, they're locked up, the line to pick up medications is long. Sometimes the pharmacy is even closed when I try to go, and overall, I just find it an experience I want to avoid. Well, it turns out I'm not the only one. As Fiona Rutherford writes in the new issue of Bloomberg Businessweek, pharmacy profit margins are falling at the biggest chains, which include CVS and Walgreens. Rite Aid declared bankruptcy just a few months ago. And a key problem for drugstores is the front of the store, where competition and inflation are making it harder to turn a profit. Jim Ellis is a Bloomberg Businessweek assistant managing editor, and he edited Fiona's story, which is featured in the new issue of Businessweek Magazine. It's available on newsstands, on the Bloomberg terminal, and at bloomberg.com/businessweek. Jim joins us from New Jersey. So Jim, you go to the pharmacy, everything's locked up, the line is long. It turns out you can get a lot of this stuff for cheaper when you order it from some of the biggest retailers online.
That's become the big problem for so many of the that's become a big problem for the drugstore chains, simply because once upon a time, people thought, oh, well, I'm going to go and buy a lot of things as I walk through the store to the back to the pharmacy. And the business model for pharmacies had been, you put that pharmacy in the back of the store. It makes people run the gauntlet through all the candy, school supplies, things like that, and they pick these things up, which is sold at a higher price than you get at other retailers, and then they'll also buy the drugs. That's been thrown sort of apart now because people have discovered that you can go to a Walmart, you can go to even Amazon's pharmacy business, you can find drugs other places. And so therefore, not only are the drugstores losing that business that comes from people picking up prescriptions, they're also losing the business of people buying basically overpriced retail items within their stores, and that's wrecking their financial model.
It's wrecking the financial model, and you could see that some people have already kind of thrown in the towel when it comes to that struggling financial model. Tim is waving his hand.
I just unless you need Tylenol in the middle of the night for a crying toddler, it's hard to find a reason, Sonali, to step inside one of these.
I don't know. I live in New York City, so I like to step inside of it. The reason I don't is because my dog barks on the line a lot, so I don't like to take him in there.
And you have to order it.
But Jim, what are the fixes here?
Well, the first fix is that they've got to come up with some way to make actually going to a pharmacy not such a hassle for a lot of customers. One of the things, particularly since COVID, is a lot of people don't like the notion that they're understaffed. Many of the pharmacies, because they've had shortages of pharmacists, because it's been so difficult to work in a pharmacy since COVID, a lot of people are confronted with lines. They're confronted with waits that they don't want to have, and it's sort of chaotic at the same time within a pharmacy, simply because the pharmacist now is not only preparing your drugs, they may be giving vaccinations, they may be doing health screenings. There's a lot of things, depending on your state, that pharmacists are allowed to do now that they weren't allowed to do before, and that's more work with fewer pharmacists. And so it's become a less, it's not like going to the doctor where you sit up and talk to your pharmacist. And nowadays it's sort of jump in, wait in line, wait, then finally you can get out, and then have to walk back through that gauntlet of things you don't want to buy because they're overpriced. So what they're trying to do is to figure out a way to get the pharmacy, back up to the front of the store. Now that's that's heresy for a lot, for people who've worked in this business for decades. But right now, that's something that Walgreens is experimenting with, putting pharmacies at the front. So you can come in, and one of the things that people don't like about going to the pharmacy, which is waiting, a lot of that goes away simply because you come in, and instead of waiting in line, you're using kiosks to put in your information, and then you just so you can, if you want, go back and wait in your car, and they text you when your order is ready. You can shop in the store if you choose to, but more importantly, you can go other places, you can walk around, or just sit in your car and be more comfortable. That's very different. It also is a pretty big gamble simply because a lot of the business model counts on that mixture of both pharmacy revenue and that sort of high margin business of retail that they sell within a drugstore.
Jim, it's so hard to hear you say this and see how it competes with the upstarts that I think have taken over in a lot of the bigger cities. Look, they're not available everywhere in the US at this point, but the fact that there are apps that you can give a phone number to your doctor when you're at the doctor's office getting a prescription written, and then something pops up on the app and asks, what time do you want this drug delivered today? Like, that is just so much easier than this process.
The convenience is something that, that brick and mortar retailers like a drug chain, a drugstore chain, they just have to deal with that. They are making, deliveries available, depends on the market, but often the deliveries that they offer are not quite as good as some of these online-only pharmacies. For example, in New York, you can get deliveries at sort of CVS's, but often it's through a third-party delivery service. And some people don't like that, and some people also get confused when they think of it as sort of, should I be getting my drugs delivered by the same person that brings my pizza?
It's not necessarily the same person, but hey, I order pizza on Fridays, so why not?
Well, the other thing, Jim, to that end, what are the risks here?
Well, one big risk is that when you change a habit, when you try to change a habit that consumers have had for 60, 70, 80 years, that will confuse them. That also can make them think, well, I've done this way before. Well, maybe if I'm going to have to do something different, maybe I will try something different. Maybe I'll try an online pharmacy. Maybe I will try some other place. Maybe I'll get my pharmacy needs done at a Walmart. Walmart's been very aggressive at expanding pharmacies in all of its major stores. And, they don't have the same potentially they don't have the same hours that some drugstore chains do, but especially since the pandemic, a lot of the hours that 24-hour pharmacies had have been cut back. So that actually is something that now other types of retailers like a Walmart can compete on. It used to be you could say, oh, my local CVS or my local Rite Aid is open 24 hours. If I get sick in the middle of the night, I can go there. I can't do that at my Walmart. Well, nowadays, a lot of pharmacies are actually, closed after 6 p.m. on the weekends. Right. A lot of pharmacies are not open at night. And so therefore, it's not that different from an opening standpoint than you could do at a big box store.
Jim Ellis, really appreciate you joining us. Bloomberg Businessweek Assistant Managing Editor. He's the editor on Fiona Rutherford's story, which is available in the new issue of Businessweek Magazine. It's on newsstands, on the Bloomberg terminal, and at bloomberg.com/businessweek.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, we just spoke to our Real Economy team reporter, Mark Niquette, about how different parts of the economy are informing voters, specifically how inflation under the Biden administration is overshadowing what has been the best time to find work in generations. On inflation, we did get a bit of good news this week with the latest CPI figures. Core CPI snapped a streak of 3 above forecast readings, and the year-over-year measure cooled to the slowest pace in 3 years. So that's the data. But how are things playing out on the ground? For customers, for businesses, for retailers. We have back with us for answers Katie Thomas, lead at the Kearney Consumer Institute. The company looks at consumer behavior data and insights to give businesses an idea about how to engage customers. Katie joins us once again from Pittsburgh. So Katie, in your most recent batch of research, what are you finding that customers are noticing when it comes to inflation? Are they noticing that it's easing? Because as we just discussed, that easing doesn't seem to be hitting voters and the polling just yet.
Yeah, well, they do comment. Fewer consumers are commenting about noticing price increases in certain key areas, such as food and gas. That being said, I think we're still seeing a bit of a struggle to connect that directly to how they feel about the economy. And so we are seeing consumers just increasingly be cautious. I think that's what you saw in the retail sales numbers this week, which is, I'm not overly concerned. I don't think we're doom and gloom, but we're seeing that slowdown that we've been anticipating, that consumers have finally reached a point where they're perhaps really having to prioritize or pick and choose how they're spending. And one of the major numbers that I'm watching, though, is personal job security. So, unemployment numbers are one measure, but it's really consumer spend is informed by how somebody individually feels about their job situation and how safe they are to either keep their job or find a new job if they need to.
It's interesting, too. When you're an investor, investors talk a lot about inflation slowing, but really it's the pace of increases slowing. And Constance Hunter over at Macro Policy Perspectives made a great point this week that for many Americans, the price is just so much higher than it was years ago for many products, services, housing. How do you view that disconnect? This idea that still people are living under the weight of these perennially higher prices, really, even if inflation is slowing at the rate it's increasing?
Right. I mean, I think you're seeing a couple different factors feed in here. So some of the unfortunate news about consumers is you're seeing savings on a decline. So there was some recovery after the high savings during the pandemic in early 2023. Now you're seeing that number a steady decline while seeing credit card delinquencies also tick up. So in some cases, unfortunately, folks probably are not, they're probably spending a little bit beyond their means. Beyond that, it's just about consumers really evaluating their discretionary spend and how they categorize spend themselves. So where are they prioritizing? Where are they making trade-offs? And how can they continue to kind of navigate this complicated environment?
What about when it comes to what many would argue has historically been discretionary spending? I'm thinking of, Katie, something like travel, which, historically, if people don't have the money to travel, at least if they don't need to travel, they're not going to spend the money to do that. What are you learning, sort of like the new normal when it comes to travel?
Yeah, I think we all have a bias to sometimes stick with the way we've defined things in the past: consumer discretionary spend, consumer staples, and some, version of needs versus wants. But what we hear from consumers is that they tend to define things a little bit differently, and they're able to really prioritize how they want to spend. Travel is a great example. So when we talk to consumers, 26% of consumers told us they consider their annual vacation to be a must-have spend. And in order to enable that, that's actually where we're seeing them pull back in other areas. So perhaps it's food and they're willing to, again, make trade-offs or even cut certain things from their typical grocery shop to really allow for that. Whereas certain items like food that feel like a staple, a lot of times there's things that they, again, can give up. Maybe I don't buy as many snacks this week. Maybe I go out to restaurants one less a week. And so I really think sometimes it's about seeing that bigger picture of how a consumer understands just how discretionary versus must-have something is.
I think we also have to differentiate types of consumers here, because you kind of hinted earlier about this idea that some consumers are feeling stress. And we saw retail earnings this week. We see more retail earnings next week. And you see upper to middle class customers trading down still. So buying cheaper goods instead of more expensive ones. A lot of commentary around how lower end consumers are feeling stretched. Where are the biggest discrepancies as you see it? Who is feeling the most pressure? And will that pressure start to widen among more groups?
Yeah, I think this is another area where we try to take a two-pronged approach at it. So one is the obvious, more traditional demographic income split. So looking at high, medium, low income. But another question we ask consumers is if they feel like they're living within their means or paycheck to paycheck. And what we found is folks that feel like they're living within their means, regardless of what income category they're in, there's more commonality there, and with the people that are living paycheck to paycheck. So I know, for instance, we saw Walmart's earnings release. I actually caught your segment on it yesterday. And I think the high income shoppers there is a great example of people. I think some of the stigma, maybe even around shopping certain stores has just slowly gone away. And as we've had these continually tightening wallets, people simply want to know they're getting the best bang for their buck on the basics.
Yeah, Katie, it's so funny. Well, I was just going to say, it's funny
sorry,
you bring that up because we were talking about this in the newsroom yesterday after those numbers came out. And there were folks around my desk just talking about how the way that Walmart's in-store offering has changed, especially when it comes to groceries in recent years, just shows that it's really trying to go after so many different types of consumers right now.
Absolutely. You see it with some of their new private label launches, but they've also done more partnerships with direct-to-consumer brands over the years. They're not the only big box retailer doing it, but they are known for being willing to test and learn, but also if something doesn't work out, they kind of cut their losses and move on from it. So I think that you're seeing all these different types of retailers really try to adapt to the consumer and take all the data that they have and give the best experience possible. And I think even they're realizing certain things that perhaps we traditionally attributed to standard demographics like income, that's not really the case. Everybody likes to get a deal. Everyone likes the best bang for their buck. And so moving away from some of those preconceived notions has enabled a lot of success for retailers that understand their value proposition.
Hey, before we let you go, Katie, I want to just get an idea of what's coming up next at the Kearney Consumer Institute. I know you have a report coming out next week about innovation, and it kind of shows the delta between how consumers see innovation versus how brands internally see innovation. Talk a little bit about what to expect there.
Yeah, well, we all know innovation's actually like pretty ambiguous as it is. It can be described to be anything from like a simple line extension to some, massively disruptive category or technological advancement. But in reality, lately, what we hear a lot of is like consumers are increasingly demanding more specialized, more niche products. And what we found when we went to consumers is that's not the case. So almost 90% of consumers told us there's either enough products in most categories or too many in some categories. So it's really about, I think, repositioning inflation to make sure we're doing it in the right way and not proliferating for innovation's sake, by just deepening some of those consumer feedback loops and really understanding when we want better, when we do just want new or more options, and kind of really trying to delineate, what's going to be most successful at any given time.
And Katie, certainly look forward to seeing that report. Thank you as always for joining us on Bloomberg Businessweek.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
It is Bloomberg Businessweek, and believe it or not, we are only, wow, look at that. Is that right? 18 minutes from the close here. Time flies, Sonali Basak, when you're having fun.
Time does fly when you're having fun.
Well, let's see what our Drive to the Close guest has to say about everything that happened over the last week. Dana Dioria is Co-Chief Investment Officer at Envestnet. It's a provider of technology to banks and RIAs. Think wealth management software and consulting services to financial advisors. Dana joins us from Pennsylvania this afternoon. Dana, good to have you with us. I want to talk a little bit about the CPI report that we got earlier this week. Once again, I've said it many times before, and I'll say it many times again. It's not the Fed's preferred measure of inflation, but we still saw a pretty big market reaction to it. What did you make of that?
I make of it that it's an overreaction. Thank you for having me. I think the market has, kind of overshot most of these reports that have come out, and, assuming, right, that the reaction is really confined to that report. We started the year at the expectation of 6 rate cuts. We're living in this world of bad news is good news. So, the fact that not only do we see some indicators in growth kind of, maybe plateauing a bit and a little bit more muted, something like having inflation come in, this report inflation and particularly core inflation coming in better, right? Not fantastic. I don't think, in line with what would rationalize rate cuts, but enough that the market can latch onto it and say, look, maybe it's 2, it's not just 1, maybe it's September, it's not November.
So you were kind of talking here about this idea of bad news is good news. And I want to ask you a question that I don't think we ask people enough, which is when bad news starts to hit the tape a little more, yes, in the early terms, we have seen the market really react well to it because of the idea of rate cuts. But how much of that is already priced in? When will bad news just start to feel like bad news?
It's such a good question. I do think that we've had a pretty poor scenario priced in, particularly for areas of the market that we don't talk about as much, like small caps. So obviously we have a market, there's more than enough discussion around the fact that we have a very concentrated market, dominated by the top several stocks, and you can, cut that line wherever you like. But when you look at something like small caps, which are, more interest rate sensitive, they are needing to go back to capital markets more frequently. We have corporate debt rolling over this year, and it really does matter to those corporate teams, how quickly that rate cut comes. So it's understandable that there's a higher beta to interest rates there. But I think that, you've seen those areas of the market certainly struggle with respect to, the larger, and this is the larger stocks, and this has been going on for a while. So I do think there's sort of a pretty negative outlook priced into that already. And that's one of the reasons that, any sign that there might be another rate cut or that it might come faster can have a nice bump, a nice impact on stocks like that because they are, kind of more maybe prepped for the worst.
Dana, what are you seeing right now on the platform when it comes to cash? And the reason I ask is because we're still waiting for that cash on the sidelines to go somewhere. And
yeah,
I'm wondering what you're seeing in terms of cash, and if you started to see allocations change from those folks who say, okay, well, we do know rates are going to go down at some point, so we want to get ahead of that and deploy this cash now. What are you seeing?
Yeah, cash is high. We've seen cash and short-term instruments in general, which, the short-term instruments are part of asset allocation, right? So if you think about how money gets deployed on our platform, a lot of it is deployed by independent financial advisors or by financial advisors that are connected with broker dealers. And then you also, of course, that I would say is differentiated from money managers, asset managers broadly distributed, where an advisor may be outsourcing that decision making to the money managers. So to an extent, some of what you see is client directed decisions for that particular client, that particular account. And then some of it is asset allocation decisions that are really cascading out from a series of models. Having said that, cash short-term instruments are high. Obviously, you're getting a return there that you haven't gotten in a long time. So it's understandable that, people are kind of parked there and earning these higher rates. I think as part of, if that short-term instrument is part of that overall asset allocation decision, it can make sense. I think where it begins to become a struggle is if it's money sitting on the sidelines, money that's, maybe longer term money that typically that client, that investor has a risk tolerance that would allow for it to be taking some equity market risk. If you look at that kind of money where maybe they pulled it out of the market from a timing perspective and now it's just sitting there, the problem there, of course, is that, fear of losing out, you're definitely losing out, right? If you look at what equities have been doing over the course of the last year, if that money really was better situated in a 60-40, you've given up a lot of returns sitting in cash.
Well, it's interesting, too. You have to wonder what things look like, not just now, but 6 months from now. If you're worried about the volatility, how do you play the market right now? Perhaps people are sitting in cash just because they're scared.
Yeah, no, you're absolutely right. And that's a typical thing, right? It's why the adage is always, it's not even just timing getting out, but it's timing getting back in. And what happens, and so often we see that people miss out on the opportunities because they're sitting there for understandable reasons. They're kind of waiting for a shakeout that may or may not materialize, but the timing of that shakeout is difficult. So what I would say is, if you're in that camp, you want to deploy money in the market, but you want something a little bit more protective. There are some strategies that, number one, you can go out a little bit on the curve on fixed income. You can have, as opposed to just cash, you can be taking some interest rate risk, some credit risk. and still you're sitting in a fixed income investment. And then, of course, if you are putting money into equities, but you're trying to hedge your bets a little bit around maybe some of the, very risk on quality, fundamental indicators like quality, technical indicators like low volatility, minimum variance portfolios are a nice place to be. Traditionally have delivered higher return per unit of risk over time, have outperformed over time. So those are typical places. I talk too about, and a lot of the folks I talk to in the industry point out that if you have small caps, which I've long stated, and this is a longer term play, right? This is not, we're going to talk in a quarter and it materialized, but longer term, small caps are a nice place to be, particularly small value, because they tend to outperform inflation over time. They tend to outperform in general over time. You have to have the stomach and the time frame. But if you like having some diversification in small cap quality is a place that folks are looking. So like a 600, right, as opposed to
Dana, always love it when you join us. Thank you so much. That's Dana Dioria, Co-Chief Investment Officer over at Envestnet. They've got a unique view into what clients are doing because they provide tech to banks and RIAs like wealth management software. They do consulting services also to financial advisors.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.